Someone is telling you to pay taxes early, voluntarily, on money you haven't even touched yet. You spent decades deferring taxes. The whole point of a 401k or a traditional IRA was to put that tax bill off until later. So why would anyone suggest doing the opposite? There's a specific set of circumstances where paying some tax now, on your own schedule, can give you more choices about what you pay later. That strategy is called a Roth conversion. In our last video, we looked at what a large tax-deferred account can mean at retirement. Mandatory withdrawals, Medicare surcharges, bracket pressure that builds over time. Today we look at the other side, what you can do before those pressures arrive. A Roth conversion is the movement of money from a traditional IRA or 401k, where contributions went in before taxes, into a Roth IRA, where qualified withdrawals can later come out tax-free. Here is the key thing to understand. The amount you convert becomes ordinary taxable income in the year you do it. Convert $60,000, and that $60,000 is added to your taxable income for the year. You pay income tax on it now at your current rate. In exchange, that money and its future growth inside the Roth can be withdrawn tax-free in retirement once the account has been open 5 years and you're at least 59 and a half. For most people near retirement, the age part is already met, so the main thing to track is that 5-year clock. There are no income limits on conversions, and since 2018 they're permanent, there's no longer a way to undo one. A Roth conversion is not a strategy for eliminating taxes. It's a decision about timing, paying part of the bill now instead of being required to pay it later. Now here is where timing matters. At a certain age, the government requires you to start drawing money out of traditional accounts whether you need it or not. These are called required minimum distributions. Under current law, the age they begin depends on when you were born. For people born in 1960 or later, that age is 75. Many people retire between 62 and 65. If they also delay Social Security, say to 67 or 68 for a larger monthly benefit, a gap opens up, several years, where neither mandatory withdrawals nor Social Security has started. A household living off savings might have modest taxable income in those years, lower than it will be once those other sources switch on. That gap between retirement and required distributions is often a natural window for Roth conversions. Let's look at a hypothetical couple. We'll call them Robert and Carol. They're 63 and 64, just retired, with about $1.2 million in traditional IRA accounts. Social Security is planned for 67 or 68. Right now, they're living off savings, so their taxable income this year is modest, and they have cash in a regular savings account to cover any tax that comes due. Because they were born after 1960, their required distributions won't begin until age 75. That gives them roughly a decade of lower income years to work with. They have 3 paths. Path 1, do nothing. The account grows tax-deferred. At 75, required distributions begin. If the account has grown to around $2 million by then, the first required withdrawal could be roughly $80,000. Mandatory, whether they need it or not, and rising in later years. Add Social Security. Under current rules, up to 85% of their benefits can count as taxable income. Stack the required distribution on top, and their taxable income could sit comfortably in the 22% federal bracket, climbing as the account and the withdrawals grow. A quick word on brackets because this trips a lot of people up. Moving into a higher bracket doesn't tax all of your income at that rate, only the dollars that spill over the line. So crossing into the 22% bracket taxes just the part above the threshold, not everything beneath it. None of this is necessarily wrong. It's simply what happens by default. Path 2, one large conversion. Robert and Carol convert $500,000 in a single year. That amount is added to their other income, pushing their taxable income well past $500,000. The top slices of that conversion are taxed in the 32 and 35% federal brackets. To pay the tax, potentially $150,000 or more, they need significant cash outside the IRA. If they instead have tax withheld from the converted amount, less money actually lands in the Roth, which works against the whole point. There's also a Medicare consequence. Medicare's income-related surcharge, known as IRMAA, the income-related monthly adjustment amount, looks back at your income from 2 years earlier. A conversion this large would push their modified adjusted gross income, their MAGI, far above the surcharge threshold, which for a married couple in 2026 is $218,000 and adjusts each year. The result, higher Part B and Part D premiums per person about 2 years later. A large one-time conversion isn't automatically wrong, but on an account this size, it's a compressed, expensive event. Path 3. Smaller conversions over several years. Robert and Carol convert about $65,000 per year during their gap years. Layered on top of their modest income, that keeps their taxable income near the top of the 12% bracket, which under 2026 tax law ends just over $100,000 for a married couple. Any amount that spills past that line is taxed at 22%, but most of each conversion stays in the lower bracket. Each year's tax bill is manageable, and they pay it from savings. Over 8 years, they might convert around $500,000, building a meaningful Roth balance and shrinking the traditional IRA, which means smaller required distributions at 75. And by spreading the income out, they keep their MAGI lower in any single year, which can help them stay under the Medicare surcharge threshold. This requires patience and the cash to pay taxes each year. It doesn't guarantee a better outcome, but it shows what using the window deliberately can look like. One timing detail worth knowing: because Medicare looks back 2 years, a conversion in your early 60s can affect the premiums you pay once you enroll at 65. For Robert and Carol, a conversion at 63 shows up in the income that sets their first-year Medicare premiums at 65. So when does a conversion tend to make sense? When your income right now is meaningfully lower than it will be once required distributions and Social Security arrive. When you have cash outside the IRA to pay the tax, when your traditional account is large enough that future distributions will push you into higher brackets, and when you want more than one tax bucket in retirement, some Roth, some traditional, so you can manage your income year by year. And when does it not? If your current tax rate is already high, converting now to avoid a possibly lower rate later doesn't obviously help. If you don't have outside cash to pay the tax, the math weakens. If your time horizon is short, there's less time for the tax-free growth to pay off. And if you live in a state with high income taxes, your state may tax the conversion too. One note on mechanics: money in a current employer's 401k often can't be converted on demand. Some plans allow an in-plan Roth conversion, others only after you leave the job or reach another qualifying event. Check with your plan administrator first. People often ask this as a yes or no. Should I do a Roth conversion? But the more useful question is several at once. How much each year, over how many years, and what's the effect on Medicare 2 years down the road? These are illustrations, not exact projections. Real numbers depend on your actual income, your deductions, your state, and the tax law in each specific year. A Roth conversion doesn't promise to erase the picture we described last time: the income stacking, the Medicare consequences, the narrowing of choices. Future tax rates are unknowable, but having some savings in a Roth gives you something a single tax bucket doesn't: a choice. You can draw from the traditional account when it makes sense, and from the Roth when preserving a lower income year matters more, instead of being forced into large, mandatory withdrawals at whatever rate applies that year. Tax diversification, spreading savings across account types, is about keeping options open, not predicting the future. Understanding what you're deciding and what it costs today versus what it might prevent later, that's what turns a vague idea into a real plan. This video is for educational purposes only and does not constitute financial, tax, or legal advice. Robert and Carol are a hypothetical illustration, and the figures are simplified to show the trade-offs. Your situation may be very different. A qualified tax advisor or financial planner can help you decide whether a conversion makes sense for you and how much to convert. If this was useful, we'd appreciate a subscription. We'll link the first video below and tell us in the comments what you'd like us to cover next.